Hi there. Are you a tax-lazy trader of UAE? Want to learn about what you need to do to pay zero corporate tax? Keep listening. Oh, and if you like this insight, kindly reshare it with other tax-lazies, subscribe to our YouTube channel or at least like this video. Thanks. The first question that a trading business in the UAE should ask itself is: what percentage of your revenue is B2B, and what percentage is B2C? You see, if your B2C revenue exceeds a certain limit, it destroys your ability to claim zero tax exemption status, otherwise known as qualifying free zone person exemption. We must find that maximum limit of your B2C revenue beyond which you could lose your qualifying free zone person exemption. Let's learn how to calculate that maximum limit of your B2C revenue. Here's how to calculate the maximum limit of your B2C revenue. The maximum limit of your B2C revenue has two criteria. It should not be more than 5% of your total revenue, let's call it the first limit. Or 5 million dirhams, let's call it the second limit. Your B2C revenue must not exceed either of the two limits so that you may claim the qualifying free zone person exemption. For example, if your total revenue is 110 million dirhams and your B2C revenue is 5.2 million dirhams. The first limit will be 5% of the total revenue of 110 million dirhams, that is 5.5 million dirhams. Oh boy, your B2C revenue is less than that. Can you claim the qualifying free zone person exemption now? The answer is no, because the second limit of your B2C revenue is 5 million dirhams, which also must not be exceeded. Let's see another example. What if your total revenue were only 90 million dirhams and your B2C revenue were 4.8 million dirhams? The good part is that this B2C revenue is already less than the second limit of 5 million dirhams. Can you now claim the qualifying free zone person exemption? In this case, the first limit will be 5% of the total revenue of 90 million dirhams, that is, 4.5 million dirhams. Your B2C revenue must also be less than this limit, which is not the case. The answer is no, because, despite the fact your B2C revenue is less than the 5 million limit, it exceeds the 5% limit. Your B2C revenue must not exceed both limits. What should the UAE traders do when their B2C revenue exceeds the limit and does not allow you to become a qualifying free zone person? There is a way. Read on. If your B2C revenue exceeds both the 5 million dirhams limit and the 5% of your total revenue limit, then consider splitting your company into two companies, that is, B2B and B2C. Your B2C business is like a tumor for the qualifying free zone person exemption. It needs to be removed from your B2B business and set up as separate entity, or else, it will destroy your qualifying free zone person exemption available for your B2B business. Or you may want to become a wholesaler so that all your revenue is B2B. That was only the first condition to claim the qualifying free zone person exemption. Now, as the second condition, we shall see where your company and warehouse are set up. Read on. So, is your company and warehouse set up in a designated zone? You only require your B2B company and goods storage to be in a designated zone to enjoy qualifying free zone person exemption. Now check if your company and your warehouse are set up in a designated zone, just a free zone or mainland. If your company is not already registered in a designated zone, then it's time to move your B2B business to a designated zone. You will need a cost-benefit analysis to compare the following. The cost of setting up your company and warehouse in a designated zone, tax savings due to moving your company to a designated zone from a simple free zone or mainland. You may be thinking, why are we using the words designated zone as different from free zone? Well, there are more than 50 free zones in the UAE, but not all of them are designated zones. There are only 24 designated zones in UAE. Designated zones are fenced zones where customs procedures apply. Moving goods in or out of a designated zone requires customs declarations being prepared by the traders registered in that designated zone. It can be a pain in the neck to prepare hundreds of customs declarations on a daily basis if your sales are sizable. To avoid that, You could use your already existing simple free zone or mainland company as buyer of goods from your designated zone company. This way arm's length profit on sale of goods from your designated zone company to your simple free zone or mainland company will stay back with the designated zone company and enjoy zero corporate tax. No more hundreds of customs declarations. The simple free zone/mainland company can then make sales to all customers, whether B2B or B2C. There will be tax on those sales, but far less than the tax you would have to pay if you hadn't gone to the designated zone and saved a big part of that tax. You may also be thinking the question, must my company and the warehouse be in the same designated zone? The answer to that is no. Your company may be in Hamria Free Zone, but the warehouse may be in Safe Zone, both designated zones. It doesn't make a difference from corporate tax view as long as your company is set up in a designated zone, and also goods move in or out from a designated zone. Let's say you have a company in Jafsa, a designated zone, but your warehouse is in Dubai Textile City, not a designated zone. You import goods directly into your DTC warehouse. Can you prepare the invoice from your Jafsa company and the income will still remain qualifying income? The answer is no. Your goods are not moving in or from a designated zone, which is a condition for your income to be a qualifying income. No qualifying income, no qualifying free zone person exemption. You may have a question, which of the two companies should import goods into the UAE, the designated zone 1 or the mainland/free zone 1? The answer to that is that the designated zone company must import goods into a designated zone and store them there. Sales should happen from designated zone, and goods should move from designated zone to the customer. You might also want to know, what about the qualifying free zone person exemption of high sea/third port sales? The answer is that if your designated zone company administers the process, then such sales will be seen as qualifying income and you will get the qualifying free zone exemption. Want to know more? Send a query to fast@taxlazy.com. For the highest quality of tax advice at the lowest price possible. That is US $100 for each question you ask. Not the answer we give. https://taxlazy.com